the vast majority of U.S. growth is connected to household consumption. And if households don't have significant spending power at their disposal because wage growth is soft and labor markets are soft, it's almost by definition, you're going to lead to weak demand. And of course, that's happening in an environment where expectations built into the equity markets remain quite elevated.
Hey everyone, and welcome to another episode of the WTFinance podcast. On this episode, I have the pleasure of welcoming back Bob Elliott. So Bob is the CIO of Unlimited Funds. Bob, thanks so much for coming back on the podcast.
Hey, yeah, thanks so much for having me. It's good to catch up.
Yeah, no problem. Yeah, it's been a while. I think it's been sort of close to 12 months. So interested to hear what you're sort of thinking about that's happened in the world. But yeah, where I'd really like to start all my conversations is very broad. What do you see in the economy?
Yeah, I think a lot of well, let's start with the United States, and I think what we see in the United States is sort of a very typical late cycle environment where there was a fair amount of monetary easing. It helped slow the economy, gradually slow the economy, and over time start to erode some of the inflationary pressures, and that is then creating the opening or the transition to easing that we've been seeing. I think the challenge that exists there is it's then been combined. If it wasn't for the negative growth policies out of the new administration, it would be a pretty boring year, to be honest. And instead, it's been quite an interesting year because you have the new administration coming in basically with two big negative growth policies, which is tariffs and constraining immigration. And those policies have created a drag on growth where, absent the AI boom, particularly in the first half of the year, we would be having a even more meaningful economic slowdown. And so I think you sort of look at that picture, and it's not a particularly strong growth picture ahead. And it's one that has inflation that remains a bit elevated. And that's not necessarily a great macro setup. Nonetheless, asset prices continue to rise on the hopes that both the tariffs somehow will be transitory, as well as the negative growth effects of the immigration will not have a meaningful effect on the economy. And then when you sort of step out of the United States, you basically have the similar sorts of dynamics happening, but just in different orders. So if you go to a place like the UK, you have a late cycle environment that has been met with tightening as well, but a slightly larger inflation problem, which has delayed the easing. And then if you go to, say, a place like Canada, kind of on the other end of the spectrum, you've had much more economic weakening and a central bank that's had to respond pretty aggressively in order to meet the needs there in terms of the overall growth slowdown. And so we're kind of all in this late cycle environment, jockeying for different positions in a broad-based easing, but one that has yet to really fully turn these developed world economies to be sustainably expanding.
Okay, yeah, really interesting. And you mentioned sort of the AI boom being a major driver of majority of the growth, especially the US, and probably why they're sort of outperforming other countries. Is that something that you think can continue, or it does seem like it's actually amazing, the equity raising and these swaps and these deals that they're doing, trillions of dollars of investment apparently. But yeah, is this something that you think can continue, or will it sort of be we just need a bit of a downwards momentum and then it could all fall apart?
Well, I think the hyperscalers are going to continue to invest, and they're all sort of incentivized to invest meaningfully, because if they end up being the winners in the AI outcome, then the investment they will have done would be totally reasonable. If anything, they'll probably get massive payoff for it. The problem is, if every company is trying to jockey for the lead in the AI boom, in the same way, say, Google became the lead in search, well, every company isn't going to win. And so a lot of that investment is going to be irrational, or at least 10 years from now, we'll look back and say that all kind of looked irrational. And so that's kind of a confusing situation, which is, individual companies engaged in rational behavior, collective action largely being irrational, the combination of which in the short term can obviously have a relatively significant impact on growth, but in any over time it is limited. I mean, it's only 1%. All that investment is only 1% of U.S. GDP, so there's only so much it could be, and we're starting to see that we're meeting an inflection point where, in order for that to continue to support growth, it has to continue to accelerate in terms of the growth rate of investment. And we're seeing that there's indications those companies are likely to, continue to invest significantly, but that the growth rate of their investment is likely to slow. So the big support for the U.S. economy from a growth perspective is probably going to fade ahead rather than ramp up.
Yeah, exactly. As you say, there's sort of, it seems hard for it to continue to accelerate in the growth, and it seems like there's more asymmetric downside risk of it slowing down versus the latter, basically.
Yeah, that's right. I mean,
yeah.
And all of this is around, and then what I'd say is, and the real, I would call it risk to the upside, is that this would create a productivity boom. But so far, we really haven't seen much in the way of meaningful productivity gains, certainly at a macro level, despite relatively high penetration of these technologies. And so, the techno optimists will always say, "Hey, look, this is it's on the horizon. It's on the horizon." The sort of rational macroeconomist looks at it and says, "Look, if the empirical evidence suggests that there's no bounce in productivity at the economy-wide level, then maybe these technologies, aren't as meaningful to economic activity, and in particular to income-earning GDP activities, than many people suspect."
Yeah, could we be seeing that in the sort of unemployment numbers and the job numbers, or is that more linked to? I know that, as you said, there's lots of these trends, so immigration, sort of potentially reverse, migration where people are leaving the country, as well as potentially that recessionary nature of the economy, where I think we're seeing any young, there's not many graduate roles. There's sort of could it be? Yeah, I guess that's my question. Is it those other trends, more common trends, or could it be AI?
Yeah, I mean, typically you see. Well, the first thing is to say it's a little hard to know exactly what the direct effects are. What I will say is typically when you see late cycle economic weakening, usually hiring starts to slow down in earlier job cohorts. And it's notable that we're seeing weakness in hiring, not just for white collar college graduates with BAs, but we're seeing it across everyone in that income cohort, which meaning regardless of education, which kind of raises the question, like, it's not like AI is lifeguarding or something like that, because we're also seeing it in summer jobs. And so what I'd say is it looks more cyclical given it's broad and not particularly concentrated in areas that would be more or less affected by AI. And so and that sort of dynamic is pretty typical, and that's combined with the fact that labor supply, and particularly in the U.S., has gone from growing. I mean, in 2024 there were 2.5 million work permits that were created, which is about 1.5% of employment in the U.S., and roughly 500,000 work permits will be canceled in 2025. So that's a 3 million job swing, or 2% of employment swing, in terms of immigration effect. And so that's also having a meaningful effect on total job creation, because literally there aren't more incremental workers that are coming into the market.
Yeah, interesting. But I guess, do you think that could lead to wage growth, and I guess there's sort of a tightening of the sort of labor market, similar to what we saw, just after COVID?
Well, I think the sort of curious thing, as Chairman Powell says, is that it just happens that there's been a reduced demand for labor right at the time that supply has come down. I think some people get confused in terms of the directionality. Like, companies are looking for labor, or they're not looking for labor, not related to the amount of labor supply, but to the amount of demand that they see and desire to hire. That has fallen a lot. It just so happens that labor supply has fallen a lot, which means that the unemployment rate hasn't risen as much as you would have expected given the slow hiring rate. And so what I'd say is labor markets are lucky to be this tight given the low supply numbers, but it doesn't really indicate a strong labor market or upward pressures on wages. If anything, it's the opposite, which is wage pressures continue to fall, and the labor markets across all sorts of different indicators are looking pretty soft these days, given the weak demand for labor.
Yeah, okay. Really interesting. And I think if we see, if we look at post-COVID, it seems like there was a lot of shifts. We saw some previous, economic correlations or, certain correlations linking to the economy. And it's like, okay, that means that we're in a recession, and a lot of them didn't play out. And there seems to see similar to what we saw in sort of the GFC, post-financial crisis, there was a shift away from many of these correlations. So do you think that is really the challenge at the moment where, there's so many things that we used to rely on to guide on the economy and they're just not working anymore?
Well, I mean, the biggest challenge right now is we have no idea what's going on with the economy because of the U.S. government shutdown, which is happening probably at the worst time, the most ambiguous time when it comes to the current economic conditions that are possible. So that's really hurting the whole understanding. But I think what we're seeing, I'm not seeing something that is meaningfully different from the traditional mechanics of an economy. I think folks come up with rules of thumb. They go, oh, 200,000 is a strong job report or something like that, sort of agnostic to what is actually occurring. Like the reality is the break-even, job market right now, job creation in the U.S. is probably 50,000 jobs or something like that. To be clear, it's been negative even with that low rate, and so it's still, the labor markets are still soft, all things considered. I think people are just kind of needing to reset and recalibrate what strong looks like in an economy that is sort of where the potential growth rate of the economy has softened so much.
Yeah, great point. And yeah, what impact do you see the sort of government shutdown having on the economy and markets? Because it seems like it hasn't really cared so far.
Yeah, the markets. When I talk about government shutdowns, I wrote a piece on my Substack recently about how, there are, if you've been in macro long enough, you sort of learn a few rules of thumb, and one of those rules of thumb is that government shutdowns don't matter, and they largely have not mattered over the last 50 years or something like that. They've had no impact on asset markets or meaningful impact on economic conditions. And the issue is that that doesn't mean that they can't have impact, and so there's two elements here today that are meaningful relative to previous ones, or at least that create some risk that may not, it may actually be impactful. The first is time does matter in these sorts of things. And so the longest shutdown we ever had was 4 or 5 weeks, but it was right around the holiday season, and which muted its effect. The way you think about it, most people think about it, it's about 1/10 of a point of GDP gets eroded from growth per week that the shutdown is in place. And so we're 4 weeks in. If this thing goes on for 3 months, it would be a very meaningful impact on reported economic conditions. The duration also starts to change people's actual behaviors. If you knew you were going to be unemployed for 1 day, it wouldn't change your behavior at all. If you knew you were going to be unemployed for 6 months, I think it does actually start to change how people behave. The other thing that's really important is that this is being used as a closet Doge 2.0 in all sorts of different ways, whether it comes to cutting government spending or firing people in a way that it's never been the case before, including some risk that people who didn't receive their incomes during the shutdown won't receive them when the government comes back. That would be a pretty notable impact in terms of how you would think about managing through the shutdown as a household being affected. And so all these things are sort of combining to sort of challenge the rule of thumb that it doesn't matter. Markets certainly don't seem to care, but the real economy could be weaker than expected as a result of these elements.
Yeah, would that be legal, or would it be? I guess it would create many legal battles between government.
My understanding is actually Trump passed a law after his 2018 shutdown that was intended to pay, that required the payment of employees who didn't receive the repayment of employees that didn't receive income during it, but during a shutdown. But I guess they're figuring out a way to challenge that. They're certainly trying to figure out a way to fire people in agencies, in undesirable agencies, or agencies or programs that are inconsistent with the administration's priorities. That was blocked by the courts for a little bit, but you never know with these things. The head of the Congressional Budget Office is trying his best to fire people as much as he possibly can. Use this as a way to fire people. So it might be more of an impact than has historically been the case.
Yeah, okay, really interesting. And it sounds like you think it's, the economy's heading to a stagflationary environment where we see higher inflation linked to tariffs and sort of other trends, especially if energy sort of reverses and starts to go up. And we also, but at the same time, there's economic weakness. So it's a challenge of how does the Fed and, the Treasury balance that sort of dichotomy. So
yeah, I mean the prices, inflation slowed for sure from the peak. But even before the tariff policies were implemented, there was a question about whether it would get down to the sort of central bank goal around 2%. And it looked like it was not. And these tariff efforts are, if anything, they're pushing inflation in the other direction. And so the idea that we're having inflation that's elevated relative to central bank targets, it seems pretty widespread. From the Fed's perspective, the Fed doesn't really care about it. Chairman Powell made it very clear in Jackson Hole that the only thing that matters to him is the labor market. And so, policy is basically being responsive to slower growth conditions, and even more than just higher unemployment, but actually slower outright growth conditions. And so they're easing into a period of elevated inflation, which and citing the inflation that is being seen as being transitory. And the last time we saw easing into elevated inflation, it didn't go so well for them. So maybe they forgot the lessons from just a few years ago.
Yeah, great point. Is sort of, but the Fed's incentivized not to act until late, and I guess the challenge then is that they, they're always in the wrong position, basically.
Yeah, well, I mean, they're certainly, I'd say, acting relatively aggressively in terms of their response to the labor market. Now, some people have argued that is reflective of political interference. Maybe there's certainly some folks on the committee that might be being influenced by the administration, but Chairman Powell is looking at the situation and saying that that they're a lot more confident that the labor market is weakening, that they're confident that inflation is likely to be persistent, given that it's being driven by the tariffs. And so you put that together, and so they're responding to the weaker labor market. So the reality is basically inflation can come in at any value and it has no impact on the Fed's behavior. The group that it does have an impact on is households who are getting squeezed, right? The Fed can choose to either care about inflation or not, but it's households have to pay the prices that are being seen, and that I think is, from a real economy perspective, is the biggest challenge, which is that households are seeing their income growth slow to something like 3 to 4%, with essentially zero job growth and 3 to 4% wage growth per worker. And prices have gone from, in the low twos back up to 3. It might be a little bit higher once tariffs flow through. And then you sort of add that up, and that's not a great situation where you have nominal spending power of 3 to 4%. And at the same time, you have prices rising at roughly 3% or a little bit higher. That leads over time to roughly a 0% real demand growth that is sustainable. And so that would be, that's a pretty undesirable economic circumstance in the United States.
Yeah, but I guess the challenge is it's sort of the best, out of the shirt in the dirty pile, because if you look at as you said, Europe, UK, I guess, Japan maybe is shifting, but, China, it does seem like there's, the US still has the benefit of many economic tailwinds, cheap energy, etc.
Yeah, I mean, the U.S. certainly the U.S. is better than a place like Canada, which is seeing a rapid deterioration in their economy. And it certainly is being benefited from the AI dynamic, but you can't, the vast majority of U.S. growth is connected to household consumption, and if households don't have significant spending power at their disposal because wage growth is soft and labor markets are soft, it's almost by definition you're going to lead to weak demand, and of course that's happening in an environment where expectations built into the equity markets remain quite elevated.
Yeah, really interesting. Great point. So yeah, what do you see happening with the markets? I guess if we look into, we sort of come to the end of the year, 2026, do you see this economic, I guess, weakness sort of permeating through to the markets, or do you think it's, hard to stop this massive bubble?
Yeah, when you look back through time, it is markets always follow the real economy. So they can diverge for a period of time, but they don't diverge forever. And so if, looks like we're transitioning to a period here of weaker economic conditions structurally in the US economy, given the combination of the soft labor markets and the negative growth dynamics that are happening from the administration's policies, stocks can continue to rally. But when you look back through time, basically every late cycle you see the same circumstance, which is expectations are super high, stocks continue to rally, and at the same time the real economy starts to deteriorate, and eventually, over 6, 9, 12 months, those things close. It's a very different circumstance than sort of earlier in expansion, where stocks are up, the economy's strong, and those are self-reinforcing to the upside. That's not what's happening now. What's happening now is actually the opposite, which is they're diverging from each other. And if you go back through time, unambiguously, every time the markets come to the economy and not the other way around.
Yeah, okay, so we can expect that to come down. And what do you, or at least potentially, I guess if it follows the trends of the past, that's what's going to happen. But if we look at, I guess, bonds and sort of precious metals, and I guess Bitcoin as well, how do you see these reacting further? Because I guess if we look at it, I guess the gold trade has sort of been linked to, lots of people saying the devaluation of the US dollar. I guess printing of massive amounts of debt has had a massive run. Do you see that continuing? And I guess, bond markets has been very slept on over the past few years, and probably for good reasons, because it's massively underperformed.
Yeah, well, I mean, I think when you look at sort of how the world is playing out between those two assets, between, let's say, gold and bonds, there's been a massive increase in demand into gold, and we've transitioned a lot of ways from composition of the demand for gold, which is really, I'd say, very sustainable with central banks buying and household demand in the East in terms of India and China. And we've actually seen, as the price has risen, we've seen both of those fade. And instead, what's happened is much of the incremental demand that we're seeing these days has come from the West, and in particular, US-based investors, and engaged in a lot of speculation around gold. And I've long favored gold. I mean, certainly as a part of a strategic portfolio, it's been a critical component. I've argued for it, but I've also tactically been bullish gold, given the flows basically from 2000 all the way up to into the 4000s. But when I saw this transition to a composition of demand that is so speculative, a couple weeks ago, I said, this is feeling pretty toppy here, and something that you want to be careful with, at least in the near term. And that was a decent call. Bonds, on the other hand, everyone hates, and in an environment where the vast majority of investors are underweight those people that I talk to on an ongoing basis. And so if we have an economic slowdown, there's a lot of catching up to do, because so many people are overweight the riskiest stocks and are underweight bonds, that you could easily see a big flush in bonds. And so whereas gold and stocks have taken have been the big winners in the last couple of years, we may be entering an environment where long forgotten bonds are going to be a winner ahead.
Yeah. Okay. Yeah. Great point, as you say. But I guess the challenge is that people have thought this is going to happen, I guess, the past few years, and it really hasn't. It's been quite interesting how high yields have remained the past few years.
Yeah, well, I think people have, have been calling for the death of bonds for a long time. And the reality is, it's pretty darn hard to have the death of bonds in an environment where central banks are easing. And so, we're seeing it's true they're not necessarily totally rallying entirely the on their own, and we're having a steepening of yield curves. But for instance, if you look at the U.S. circumstance today, the steepness of the U.S. yield curve, let's say the twos tens, something like that, or the twos 30s, depending on what you want to look at, is at a normal level of steepness, meaning like it's not like there's some grand run out of bonds on the long end. It's the Fed is cutting, and that's supported bonds, and you're getting a normal level of steepness in the curve, which you'd expect is very typical of late cycle environments. And as far as I can tell, there's nothing that's indicating that bonds won't perform consistent with what their historical relationships have been.
Okay, so you don't think they'll sort of lose control of the long end of the bond market, basically?
No, because there's no reason to lose the long end of the bond market. Meaning, um, if the bond market, for some reason, the long end rates are inconsistent with necessary monetary policy, the solution is relatively clear, which is you just buy the bonds, and you bring down cash rates and you buy the bonds to the extent that you need to in order to ensure that there isn't an unacceptably steep yield curve. And so far, we're so far away from an unacceptably steep yield curve that we're on totally normal environment right now. So if you think about that, like current environment, totally normal. They have all the tools that they need in order to contain any bond yield rises. The primary cost is that it would cause the currency to fall. But as very simple example, every developed world currency over the last 2 years has fallen something like 50% in gold terms. And has anyone noticed? Like, it doesn't affect anyone's day to day.
Yeah, true. That's a great point. And as you say, they can just come in and we haven't even got QE yet. So if they wanted to do that, they could. It is basically yield control.
That's exactly right. They have all the power in the world to control the bond market, and I think there are trade-offs in the sense of to control the bond market means to devalue the currency, particularly relative to hard assets. But keeping bond yields consistent with how things are going in terms of economic activity is very directly impactful to people in a way that, look, if precious metals rise, it doesn't really affect people's day-to-day lives.
Yeah, I'm sure there'll be a surprising correlation where if if bond prices go up, then probably gold will come down or something. It'll be something weird like that. How you think these things will act in certain ways, but they act in the complete opposite.
Exactly. I mean, that's probably it's very easy. It's definitely possible because gold is transition. I mean, gold is always a financial asset, so it's always important to recognize gold has always been a financial asset, and there are certain times when, as a result, gold and bonds trade opposite to each other. For instance, there were times in the financial crisis where leverage was limited, and so it caused liquidations of long gold positions, and gold traded down at a time when bonds were trading up. Why? Because gold is a risky asset and riskier than bonds from many others' perspective. And so the dynamics that you're talking about could easily play out where bonds rally and gold sells off, given that it has been driven by more speculative demand in the recent period.
Yeah, okay, really interesting. And is there anything else that you're currently watching and you sort of like how it looks, I guess, asset class or potentially sector?
No, I mean, we pretty much covered it. I mean, I think probably the only other sort of interesting spot in the world, which is that oil's pricing in a very weak set of conditions, which is a notable contrast to what we're seeing in things like the equity markets. And so it doesn't take much to create a pop in oil. Like if you think growth is going to be stronger than people expect, like it doesn't make a lot of sense to bet that in stocks, given it's already relatively priced in. Whereas in the commodity markets, there's probably a lot more room to run if you think that growth is going to be stronger than expected. Or said differently, holding commodity assets relative to equities could be a compelling trade if you think that there's going to be an economic slowdown ahead.
Yeah, and I guess the challenge with oil at the moment is sort of the supply demand dynamic with lots of OPEC supply coming online. As you say, the demand could increase, but then does it increase enough to offset many of these new projects coming online as well as this OPEC demand?
Yeah, I think it's an interesting question. That's why I like the range trading in oil, because once you get into the $60 range and below, you start to get projects in North America that aren't economically viable, and so that creates almost like a natural floor. If oil was trading at 80 or 90, I'd say you got to watch out for the supply because it can easily come online. But at I mean, what did it trade into the high 50s a couple of days ago? That was a good time to come in and pick up some oil, given the range trading behavior of it.
Yeah, very, very true. So, Bob, thanks so much for your time today. We sort of covered, gone everywhere.
We
But my
covered it
last
all.
question, covered it all. Yeah, commodities, bonds, equities, in the world. But what is one message you want people to take away from our conversation?
Oh, well, I mean, I think this is one of the more challenging times in markets because these late cycle environments where expectations are high and then the economy's shifting and you don't exactly know when asset prices are going to come down to earth. It's a really important time to remain agile. And so you either have to be able to do that yourself, meaning trade, the markets that you're seeing. I'm just looking at gold recently, or you've got to find strategies that can do the tactical allocations themselves so that you don't have to. And so, whereas there are certain times when it's like just buy and don't worry about it, and times are good, this is much more likely to be a time that's going to be more challenging, where you're going to have to be nimble in order to be successful.
Perfect. Great message. So thanks again. If anyone wanted to find out more about your work and what you do, where would the best place for that be?
Yeah, for sure. Probably the best thing is you could find me on all the socials under the @Bobby Unlimited handle. I'm on Twitter, LinkedIn, YouTube, even have TikTok. Or check me out on Substack for sort of longer form writing under the brand Non-Consensus.
Great. Perfect. I'll put the description below, but thanks again for your time.
Thanks so much for having me.
Hey everyone, thank you for listening. I really appreciate the support. If you've got value out of this, I'd really appreciate it if you could like, subscribe, or comment, good or bad feedback. I'm always open to that, but it really helps with the channel. As I said before, only about 14% of people actually subscribe to this channel. So if you were to that, it would really help. It could mean we could continue to grow. If not, thanks for watching and see you on the next show. And you also might like this video right here. All right, thanks again.